Welcome to our 5 at 5 show, which today is sponsored by Altech Chemicals and Theta Gold Mines, and is brought to you in association with the, actually, I'm just going to go and stop again. Just going to go back a step, which is sponsored by Altech Chemicals and Theta Gold Mines, and is brought to you in association with Resource Global Network. For those of you attending 5 at 5 for the first time, the aim of 5 at 5, 5 guests at 5 p.m, is to maintain engagement between investors and miners through a lively interactive format whilst we wait the return of physical events. A few admin announcements. To make the sessions as interactive as possible, please have your video switched on. To ask a question, you have two options. You can either submit them via the chat function, which is at the bottom of the screen, or you are more than welcome to go and wave your hand. We can unmute you and you can ask your question live. We'll also be having some polling questions throughout the webinar where you can vote. And for this week's show, which is episode 94, we have an ASX theme focus to discuss some key issues of the day. Our guest lineup today is Iggy Tam, Managing Director of Altech Chemicals. I
think we've lost Andrew there. Let's see if he comes back on. Otherwise, we can have some fun and start without him. There he is. Andrew, we've lost you. There, that's okay.
All right, you carry on, Richard.
Okay, Nick. It must have been all that rubbish. Andrew was talking about the English cricket team coming out to Australia and how they're going to actually win a game. That someone's pulled the plug on his internet connection. But I'll thank him anyway. Thank you, Andrew, and thank you to Minds and Money for hosting this online event. They're quite popular these days. Yes, my name is Richard Morrow, and I'm chairman of the Melbourne Mining Club. It's a great pleasure and honour to host today's 5 at 5, coming to you from Melbourne, and guests from 4 corners of Australia, as a matter of fact. Interesting times in the resources space, particularly hard rock mining. The battery metal sector is front and centre, as electric vehicles are carving out a bigger and bigger part of the overall vehicle market. My people estimate that the electric vehicles will push up to 60% penetration rate of all vehicle sales in coming years, and moving to more than 30% of the overall number of vehicles on the road. That's quite something. Prices of the main battery metals are very firm, especially lithium and its derivatives. Looking forward to hearing more from Iggy about how Altech is manoeuvring in this space. Gold is hanging tough around $1,800 an ounce, and playing second fiddle to cryptocurrencies these days. As an old gold bug, I think gold and silver will always have a role to play. Delighted to have Bill Guy presenting today with his projects in the former home of gold mining, South Africa. Our other guests and sponsors this afternoon are other people project managers like to know, the ones that can truly make or break a project, the money men. I'll go by seniority here. Clive is a very well-known name in the WA mining circles, and I'm delighted to have him with us today. Clive has probably forgotten more about project financing than most of us will ever know. Daniel Porter from Pure Asset Management is one of the new breed of financiers, and Pure is certainly making its mark in the mid-cap space and in some metals and commodities that we wouldn't call mainstream. We'll hear more from Daniel in a few minutes. But first, guys, let's get up, let's get thinking, let's get rid of that trading day lethargy by getting a little audience participation happening here. This is the equivalent of me being one of those annoying MCs that ask you to get up and stretch before the events get started. You know the type, you hate them, don't you? But we're going to have a poll. The percentage of your mining portfolio in ASX listed stocks. This is a question. Oh, a few of you people have got in there voting already before I've gone through all my rubbish I was going to say, but that's okay. There's only one right answer here for the true believers. So cast your vote. Let's have a crack. And if you get it wrong, we won't boot you off 505 unless you say none, that is. And there's 4 brave people there at the moment saying none, that is. So how much should you have in Aussie stocks? Get your thinking caps on. While we're voting, let's hear from Daniel and Clive and ask how they are seeing things out there. Daniel, Pura's been pretty busy out there in the funding market. How are you seeing demand for innovating financing at present, and what are you up to?
Yeah, thanks, Richard. I would have to say that it has been a very, very busy 12 months, despite lockdowns in most of Australia for a good chunk of this year as well. We've certainly been run off our feet at Pure. There's been a lot of inbound interest in our product, and certainly I think we're sitting quite well for a really robust funding environment over the next 12 to 24 months. I might just share a little presentation that we have as well. I just will run through a little bit about Pure and what we do, because it is a slightly unique funding approach, but certainly one that is finding a lot of success in a lot of good homes and a lot of good projects at the moment. So just in terms of what we do, we're a hybrid debt fund. We look at debt through an equity lens, if you like. Deploy debt into projects and smaller projects at that for that matter. We definitely look at projects with an equity mindset, equity owners in the projects, and we want to make the bulk of our returns from the equity investments that we make as well. So look, the real crux of the fund at the minute is this building demand for capital that we see taking place over the next 2 to 3 years. We've seen really strong runs in commodity prices. That's driven exploration. That's usually a pretty good indicator of forward-looking capex, although that capex cycle really hasn't caught up yet. You get a 12 to 24 month lag on that. We're still seeing companies being a little bit cautious, particularly at some of the larger end, but certainly at that smaller mid-cap end, we're starting to see some really strong signs of life. But it is getting harder for small cap resources companies, and that's why we've structured the fund in the way that we have. Two charts on this page look at the relative multiples of ASX resources stocks versus the ASX 200 industrials. And you can see there over the past decade, the sector has derated quite considerably. And that's probably due to the fact that we're seeing a lot less analyst coverage. You can see here that at the peak, about 8 years ago, there was around 1.4 analysts covering each stock in that sort of 10 to 500 mil small cap range. Today, it's down to 0.3. We're seeing a lot of those investment banks pull a lot of resources out of the resources space, and that's leading to the derating. But at the same time, that means that the cost of capital and the cost of implied equity capital, for that matter, is rising quite significantly. So what we do is we take a slightly different approach, and we offer debt to smaller companies, and we offer 2 main products. One is a convertible product, which we all probably understand. We always look at conversion terms at a premium to valuation. Oftentimes this works quite well in an unlisted environment. And then we also offer a bond warrant, which is basically a very similar type of facility in that there's debt on one side and equity on the other, but there is no conversion element to that. It's straight debt with an option on the other side, or a warrant in this case, as it's bespoke. And the reason that we do that, and where we're finding most success, is the dilution that we're offering. So if we look at a cost of capital on a holistic basis, our cost of funding is far less dilutive than just raising straight equity. And at the same time, we're aligned with shareholders in that we want to see that equity re-rate and see these projects take off. That's where we make around 80% of the returns of our fund are on that equity side. In terms of how we work, you can a slide here for what we sort of look at in terms of key specifics, but really looking at that small cap end, that $5 to $15 million space. And then we work with a couple of independent experts as well, just to make sure that all the technical aspects are covered off of all of our projects. And where the project sort of finance that or the financing that we're looking at really works well from our perspective is really in that pre-project finance stage. So debt obviously won't work at a too early stage. We think that's more of an equity play. We can see on this Lassonde curve here, there is definite share price movements, and particularly when companies are come raise, they might have a big project that they're lining up. The market expects that company to come to the market. The share price is, you know, in the toilet. The cost of equity is exceptionally high at that point. That's the point where our facility works quite well. So we do look for a few parameters, you know, defined reserves, permitting fairly well done, and a feasibility study or similar done. But on the whole, we're finding a good set of developments that fit this bill quite nicely. And what we'll look to fund as well, look, we're pretty open-minded and pretty flexible in that. Here's just a few case studies of what we look at where we've already put some money to work. But particularly at the moment, what we're finding a lot of demand for is M&A. So on the small cap M&A side, and then brownfield restarts. With commodity prices so strong at the moment, it really does make a lot of sense for a lot of companies to go back in, and particularly where we've had, you know, where we've had some good traction is on the critical minerals side as well. We've seen some really good, strong interest out of that in some unusual commodities. One that Rich is probably quite familiar with, that being tungsten, but you know, certainly we're finding a good demand for what is a fund and a product that's still sort of only about 7 or 8 months old. So I'll leave that there in terms of that slideshow. But happy to field any questions that you might have, and hopefully that gives the listeners a bit of an overview on Pure and what we do. But we are growing quickly, and hopefully we're a stronger force in coming years in that project financing market.
Oh, that's great, Daniel, and we'll come back to you. We'll circle back on that issue, and particularly about, you know, who has which financiers have probably deserted the financing space a bit later on the show. But now we'll move to Clive Donner. Clive, thank you for joining us this afternoon. And wow, is there anything you haven't seen in the project financing space, and what sort of changes and what sort of developments are catching your eye at the moment?
Well, I think just to follow on from Daniel, there has been a trend where the banks have come and gone, and there's certainly fewer of them in the space. Rothschilds was very prolific in the space when I ran the project finance business, and they sold out to Investec, who eventually got out of that business. You're left with 2 or 3 core banks, a bunch of financiers in Canada, and then the African market has its own financiers, which struggle a bit through Reserve Bank issues. So they tend to be constrained towards SADC countries. So the market, there are startups in the debt space, like Daniel's and others. There's Taurus. There are larger private equity style funds. My earlier 2 funds were like that, where I did both debt and equity. And you have some pure debt funds, and then you have government agencies like NAIF and ECA finance groups around the world. So the capital availability is there, but it's shared amongst fewer players. And the very large private equity firms, who are typically European or US, cover multiple industry sets. And as a consequence, they don't generally have the skills required to look at mining risk in the sort of startup feasibility stage. So it's always difficult to find the right licks of capital from the right type of financiers. We're also in a world now where we've sort of moved on from pure base metals, bulks, and precious, and we're dealing with critical minerals, battery minerals, rare earths, etc., which are traditionally much harder to finance. So the trend in the past has been, looking for an offtake partner through a take or pay. financing against that. But I think the financiers are going to have to be more brave, a little more structured, a little more creative to be able to get these deals away. And at the same time, leveraging up complicated new industries with too much debt. In a conventional sense, we used to think 60% leverage was about right for a traditional project. And it's not that easy to run those ratios around for critical minerals and battery metals, which have a long startup curve. They have a lot of issues of quality control and testing, and they require lots of working capital to get to steady state. So the industry has some challenges. But by and large, if you just look at the Australian market, we currently have about $300 to $350 billion of projects in the pipeline, ranging from all the usual suspects, including petroleum and LNG, etc. About half of that is in Western Australia alone. So you can see, as a resource country, Australia is really humming. These new metals and minerals have added enormous opportunity for Australia. And we are geographically very well endowed with most of the stuff that the world wants in the new technology revolution.
Thank you, Clive. Well, listen, thank you for those remarks. And that's a great segue to our first company presenter today, Iggy Tan from Altech. We'll circle back on a few of those thoughts, Clive, a bit later on if we can. But it's now my great pleasure to introduce Iggy Tan, the Managing Director of Altech Chemicals, ASX code ATC. You know, he's a highly experienced mining and chemical executive with several significant achievements in commercial mining projects up his sleeve. And Iggy has over 30 years chemical and mining experience, and as an executive director of a number of ASX listed companies. Welcome today, Iggy. Let's get into your presentation, mate.
Thank you, Richard. So thank you, everyone. Altech Chemicals is an Australian company. We're listed on the Australian Stock Exchange. And I'd just like to show you a short video, which is really talking about our latest alumina coating technology, which is a very interesting game-changing opportunity for the lithium-ion battery industry. So
have we lost it? Iggy there? You're right.
Let me try that again.
Yeah. Maybe we can circle back to it, Iggy. We'll go through the other slides first, if you like.
Yeah. All right. Can anyone see that?
No. Do you want to try doing a screen share again?
Yeah. Sorry about that, everyone. Can you see that?
Yep.
Perfect.
No volume coming through.
Okay, that's all right. I'll turn it off.
We can see that on your website, can we, if we all go there, Iggy?
Yeah.
Okay, must do that. While Iggy's saying that, I'll just give you the results of the ASX, the poll. We had, where am I? 31% of you said that you should have 100% of your investment in ASX listed. The more cautious ones, the 50 to 100, with 35% of the audience. 0 to 50%, the real ones lacking courage. They're 12%, and would you believe 23% voted for none? You're all booted off this presentation today. Iggy, back to you. Sorry about that.
Yeah. All right. Good. See whether I can do that. Can anyone see that?
Yeah.
Okay, good. All right, in the lithium-ion battery, you've got lithium ions on the cathode, and when you first charge the battery, the lithium ions go across from the cathode to the anode side. And what happens is that when you discharge it, 10% of the lithium stays on the anode side and is actually inactive to the battery. It's called the first cycle loss, and it forms a layer around the graphite and it becomes inactive. What we are doing is basically using our alumina technology to coat the graphite material to prevent this first cycle loss. And what we are really trying to use this technology is for silicon material. As Elon Musk mentioned in the last battery day, silicon is the most promising anode material in the future of lithium-ion batteries. And the reason for that is it's got 10% of, it's got 10 times, silicon has 10 times the energy capacity of graphite. Now, just give you an example, it takes 6 carbon atoms to hold 1 lithium ion, but it takes 1 silicon atom to hold 4 lithium ions. So once you can put lithium in your anode of the battery, you can see the energy density increase. Now, if silicon is such a great anode material, why isn't it being used in lithium batteries today? Basically, there are 3 problems with lithium metallurgical silicon. It expands 300% in volume and it fractures through the lithiation process. The other problem is that instead of the first cycle loss of 10% with graphite, it's probably close to 50%. So he grabs 50% of the lithium in the battery and makes it inactive. Now, if you don't resolve these 2 problems, you'll never get silicon in your batteries. Now, we have technology using alumina coatings. We believe that will resolve the 2 problems. And essentially, we put on a nano layer of alumina, about 2 nanometers. A nanometer is about 1/1,000,000th of a millimeter. A very thin layer of alumina goes around the silicon, and it doesn't stop the operation of the battery. So this is very exciting because, just to give you an example, if we can add 10% of silicon in an anode of the battery, the density, energy capacity of the battery virtually doubles. So from nearly 372 milliamps per gram, it'll go up to about 700 milliamps per gram. If you add 20% of silicon, it triples. So the impact to the lithium-ion battery is dramatic if we can resolve this problem. Now, we've taken our technology, we have our own research and development lab in Perth, and virtually we have created this type of material with the alumina coating. We've now put it into batteries, and all the results appear very promising and encouraging, and our confidence level is growing every day. Now, instead of being just a research and development company, essentially we're also running the commercialization process alongside it. We are conducting a pre-feasibility study for a battery materials plant in Saxony in Germany to produce 10,000 tons per annum of this silicon graphite material. We decided to situate the plant in Germany because essentially the lithium-ion battery story will be about Europe. It's fair to say that lithium-ion batteries has been about Japan, Korea, and China in the last many years, but in the next decade is going to be all about Europe. And the reason for that is essentially regulations, EU regulations on CO2 emissions. All car companies have to average below 95 grams of CO2 per kilometer. And in order to achieve that, they virtually have to go all electric. So you have car companies like BMW, Volkswagen, all the European car manufacturers have announced that they will go all electric by 2030. So essentially, you won't be able to buy an ICE car in Europe. All will be produced as electric vehicles. And so in order to meet that, something like 600 gigawatts of battery capacity have been announced for Europe. Companies like CATL, Tesla, Freyr, and so on have all announced battery capacities in Europe. And what Europe has said is that they don't want to rely on raw materials coming from outside Europe. So they're sourcing everything from within Europe. And that's why we're going to build our battery materials plant. Obviously, our project started as a high purity alumina project, and we are still focused on that. We are currently through the funding process. We've already got a senior loan from KfW IPEX Bank. We're currently through a green bond process for the secondary loan and also an equity process. So that's a quick summary of our project. We're using alumina coating technology, high purity alumina coating technology, and going downstream and getting it to the end battery market. Thank you. I'm sorry about the slides, didn't work that well.
No, that's all right, Iggy. Thank you for that presentation. It's being in WA, Clive. You would have seen a tiny bit of this, no doubt, in your journeys. How hard would something as advanced technology as Iggy be to meet up against conventional finance? What are your thoughts there?
Well, I think it's not as bad as you think, because conventional financing, I think, would only come in once things were operating, unless, Macquarie Bank or someone like that was put in something very structured. And I notice you've said they'd be coming in for 90 million. Usually the sort of financing that gets these projects up and running are all related to offtake and the requirement to either build the plant or through some ECA initiative in the country that's supplying the product, not the product, but the construction parts, and the offtake partners. So I would have thought that if the chemistry proves as it should do, and you become a game changer, you won't have any problem in financing this. It's really getting pilot plants to demonstrate that it works, and then upscaling it from pilot to real production is another level of risk. So I'm sure that it'll work out well. I just have a few questions really on some of the issues relating to financing, Iggy. One is the Mitsubishi offtake a take or pay?
No. So as you know, a lot of these chemical offtakes, unlike commodity offtakes, they're not take or pay, and that's one of the issues with financing. The financier has to take some market risk. They can't hedge it, and so the Mitsubishi offtake is an offtake and isn't take or pay or a fixed price.
Yeah, which is much harder.
Yeah.
Is that? Can I just jump in? Sorry, Clive. Is that more a marketing agreement than Iggy? And are there any floor prices in that at all?
No, there are no floor prices, because our view is that there will be a shortage of materials, so we want it as market price, and we get paid directly from Mitsubishi, and then they sell it to their customers. So the risk, it's not a marketing agreement. The marketing agreement, they generally get a percentage of sales. This, they take the risk, they buy the material and then sell to their end customers.
Yeah.
And there's certainly an amount of green social financing in this as well. You mentioned green bonds. I mean, that's obviously a part of the a new part of the market, a new pool of capital that's investing on a social basis. That would be very attuned to what you're doing there, Iggy, wouldn't it?
Yeah, absolutely. And I think Clive will agree. There's a lot of money swirling around looking for ESG projects. What we had to do was accredit our project as a green project, because We have a disruptive process where we don't use aluminium metal as the feedstock, which is the current process. We use kaolin as a feedstock, which essentially reduces the greenhouse footprint by 49% per ton of HPA. And we got the project accredited by Cicero out of Norway. And so we are able to call this a green project and accessing money that is looking for green projects, so via the green bonds market.
Well, that's going to be a very interesting thing. Well, we'll circle back for a few of those questions a bit later on, Iggy. But at this moment, I'd thank you very much for that. I'd now like to move to our second presenter tonight, Bill Guy, Chairman of Theta Gold Mines, where the ASX code is TGM. Bill has over 28 years experience in exploration and resource development in Asia, Australia and Europe. Bill's had numerous managing director and CEO roles, including Longford Resources, Bly Resources, and he previously served as exploration manager for Jupiter Mines, which has been very active also in Southern Africa. So Bill, please, love to hear your presentation now.
Thanks, guys. Hi, thanks, Richard. Obviously, Theta is a gold mine developer in South Africa. We've currently got a market capitalisation of about 100 million Aussie. We've got a large portfolio of ground. South Africa's obviously produced about 40 to 50% of the world's gold. So it's a great place to be in terms of resources. It's got some of the best regional geology I've seen in terms of discovery. And currently Theta has one of the top 3 undeveloped gold resources on the ASX today with the code TGM. So disclaimer there. So we're situated 370 km northeast of Johannesburg in the Eastern Transvaal Goldfield. We control 62,000 hectares of that field, which is about 80% of it. So we dominate and control our goldfield. The guys on site, there's over 35 staff on site today, initiating the project, doing some underground development work and trial mining. So that's ongoing as we speak. We're currently working on the first 6 mines. Historically, there's been over 43 mines here. So we just want to concentrate on the first 6 to get to our targeted 160,000 ounces over the next 5 years. We've got a relatively low development cost as we've got nearly 100 kilometres of underground workings. We've got a plant footprint, we've got a tailings dam. So a lot of those key infrastructure things are already there, roads, electricity, etc. We've got, basically it will be done in a couple of phases. So phase 1 looks at the first 3 mines. We expect post phase 1 to be fully self-funded. We'll have to be self-funded. So we see this as a growth opportunity for the investor. So we've already completed the pre-feasibility for the first 3 underground mines, which represents about 16% of the total underground resource, which is over 4.5 million ounces. But the idea was really to concentrate on that easy access underground material, which is already measured and indicated. So through that process, we could get to PFS relatively cheaply. We're already completing a DFS for Q1 2023. And there'll also be a resource upgrade at that point as well. So you really got to look at these 3 projects as the beginning of the project. We've got a very short payback period of 13 months from first gold. There's 490,000 ounces over the life of mine. This gives us about 7.5 years. It peaks at about 70,000 ounces. And we know when we bring the other 3 mines online, we can get up to 160,000 ounces. So the idea really is these are very large flat tabular reef systems. So we put a number of mining units into those mining complexes. We know with 3 underground mining units, we get 70,000 ounces. And we know if we put 7 mining units in there, we can get up to 160,000 ounces. The project demonstrates a good internal rate of return of 82%. Net present value of about $100 million US. Total capex requirement between 60 and 80,000 US. So just in terms of why Theta currently is in the top 3 resources, undeveloped resources not controlled by a major. So we've got size. In terms of investor value, we've undervalued compared to our peers, so we're still offering good value to the shareholder. Got a lot of potential here. We have 130 years of historical data, which we can use and put into our exploration models and grow the resource. We've got potential to generate up to 160,000 ounces a year, which would make Theta a mid-tier gold producer. We've got low production costs. So the only sustaining cost for the first 3 mines was $905 US. It's about $1,210 Aussie, which compares very well to existing mines and mines around the world. We've got a very experienced team. Essentially, we've got staff from Harmony and Goldfields now coming in to develop and deliver the operation. They're believers, the hardcore miners out of South Africa are coming in to be part of this project. That's great news. And on site, we've got flexibilities because we've got so many mines and access points. If something doesn't work out, we can start somewhere else. There's a lot of optionality there. It's a very large resource base and very shallow. So when we say 6 million ounces, everything's less than 400 meters from the surface. There's no deep mines here and very few shafts at all. Really, most of it's access from surface through stopes. In general, the roofs actually pop out the side of the hill. So it's not that hard to find them. Socioeconomically, we live in a very quiet part of South Africa down here, like sort of country New South Wales. There's very high unemployment. So the locals are very supportive of this project. There's 1,500 jobs here we think we can create over the next 5 years. Town's relatively depressed because there was a bit of tourism, but that's been destroyed by COVID. So, we see great potential in terms of the resource, in terms of production, and we've delivered the team now that can grow this project. So very short presentation today, so I'll just thank everyone for listening. Thank you.
Thanks, Bill. Wow, 136 years ago mining. Sounds a bit like my home state here in Victoria. But what infrastructure is left behind from that? You've got tailings facilities, you've got pads for a plant. You mentioned the underground development, but what have you got on the surface?
Yeah, sure. So there's administration buildings, there's machinery sheds. We used to own a series of houses. We've sold a couple of them, to be honest. Often you go down the road and we find we own things we didn't even realize, to be honest. So you've got to remember this ground package has been intact for nearly 130 years. It was TGME was South Africa's first incorporated gold company. So, we have electricity. We just got a brand new electricity line last month. They put into the town. So 2 electricity lines coming to town so we can help run off grid power for the plant. So that was a big bonus. That electricity line runs around down the whole northern section of the mine. So Valhawk, Beta, CDM will all have good access to electricity and grid power. So at the moment, everything seems to be going our way, Clive. So it's good.
That's great. I'm getting a couple of questions here through the chat function there. So please send more of those in. But first of all, we will go to Daniel Porter, if we could, from Pure Asset Management. Daniel, do you do much gold? I mean, is this something that you would look at?
Yeah, definitely. I mean, we don't have an ASX only mandate in the fund. We can invest internationally. We've made a couple of international investments already, albeit in North America. And gold is something that we're pretty bullish on over the next 1 to 2 years as well. Obviously, the price has picked up in the last month or so, which is very pleasing to see. But as an inflation hedge, I think gold's probably in a good position to be a good performer over the next over 2022. So it's something that we're definitely looking at. We're looking at a couple of gold projects in the fund right now as well. So definitely have a favourable view on that commodity. Just in terms of the site itself, Bill, are there any sort of rehab liabilities, or do you need to get any permits or mining licenses reinstated on the site, or is it all sort of good to go? How's that all shaping up?
Yeah, sure. It's in South Africa, it's a relatively complicated licensing process, to be honest. It's there's a lot of paperwork. So we have 9 mining rights, all in various stages of permitting, but they're all executed mining rights. So on top of that, you have what they call a mining works program. And that every time you change that mining works program, you're sort of triggering permitting issues. So it depends what the guys on site feel they can live within the old mining works program or not. So currently we're doing change of mining works program for MR83, which is the first 3 mines. I'll be submitting documentation at the end of this year. Then the department's got about a month to 6 weeks to respond. Then you put in a final submission and you go through the process. It's all pretty regulated in terms of timeline and what you need to do. It is a complicated process. We've completed numerous environmental studies, etc. But we do have a couple of things here in our favour. One, the first 3 mines are just extensions of existing mines, so they already exist. And 2, we have a surface footprint that we're not going to change. So by restricting ourselves to these high-grade underground mines, there's very little side effect for the surface environment. So we keep that really to a minimum, and we can stay within our original plant footprint as well.
Okay, it's good to hear. And have you, I think you said earlier, DFS expected Q1 23, is that right?
Yeah, basically we'll be delivering a definitive feasibility study Q1 2023. The guys are doing that now. So we've already delivered a pre-feasibility study, but what's happening on site is the guys are doing underground mining trials and making safe some of the old stopes. So, you know, we can put really hard, fast numbers into that, definitive feasibility study. Just won't be a paper assumption.
Yeah, gotcha. And are you using Australian contractors to do that as well at the moment, Bill, or are you talking to Australian contractors to, obviously there's a few based in Perth that are pretty good at the underground gold space, so I thought you might have had a chat with a couple of those.
Yeah, I'll be very honest, not so much. So our new CEO and COO will be sort of running the contract. We'll be doing our own underground mining, to be honest.
Okay. Yep.
Essentially, they both had over 14 years in Harmony building and developing and mining. COO Jark had 10,000 guys underneath him in Harmony. He was in charge of the South Deeps extension. You know, so they're very familiar with mining there in South Africa. So we don't feel we need a contractor for the underground. If we did the open pit, we'll probably bring in a contractor.
Yeah, great. And just in terms of your mill there as well, Bill, what sort of state is that in? And do you need to do sort of tertiary crushing or anything like that, or how's that all shaping up now?
Yeah, so basically we did deliver a mill to site about 2 years ago. We got pretty excited. It's a big mill. It can cater for our whole expansion. I think what the guys are doing now with phase 1, there will be preliminary tertiary crushing and some fine grinding as well. Every reef, there's 21 historical gold reefs here. They all have different metallurgical properties. So it really depends on which one we start with, which will be, you know, defined through that DFS. But, you know, we know gold recovery sort of varies between 86 to 95%, depending on whether it's oxide transition or it's got a refractory component.
Okay. Great.
Thanks.
So I won't take any more time, but thanks, Bill. Yeah.
No, there's great questions there, Daniel. I just move on to Clive if I can. Clive, the second time around or third time around and rehab type revisiting, I suppose probably a better word, projects such as this one throw up any usual problems with financing, or is it sort of very much straight up and down? You get the PFS or the BFS and away you go. How's your thinking on that?
Richard, I think if the project was sitting in Australia, it would be worth substantially more than where it is. And the discount that Bill is currently seeing on his price is really, I guess, an issue of location and regulation and country risk, which is, not unique to South Africa or Africa, but it exists all throughout the world, which makes this business quite tough. I think it's a big advantage to have historical data for grade and MEC purposes. It's and also mining and dilution issues, etc. I think once they do the DFS, they'll be in a much better position to get financed. And I suspect with the sort of capex they're talking about, they would get that pretty quickly and pretty easily, because most of the work's been done with some shafts and edits etc. The real issue, I guess, Bill, is what approvals you ultimately need. And I am familiar with the South African mining environment, and in fact, I helped a company in a similar position go through this exact thing. They bought an enormous amount of data from a major, and they digitized it all and put it together, and they still had to drill from underground locations and confirm the grades, etc. What sort of global grade do you expect, head grade, on a measured and indicated confident resource do you think you'll get? 4?
Okay. Yeah, sure. So essentially, we've done all those processes you talked about. We've scanned the old maps, we've digitized them, we've put in the geological database, etc. We've completed over 20,000 meters of drilling ourselves. We have over 100,000 data points in our database in the underground section. We have over 1,280 drill holes in that database as well. In terms of grade, we have a 4.17 gram as a global resource for all, everything, including the inferred. Generally, the indicated runs around 5.5 to 6.5. Pretty confident about that. Historically, it's always mined, from production levels, about 7, sort of in the 40s and 60s. If we look back at the 1800s, they were really only interested in a paying limit of 18 grams. And now we have a better idea of the structure. We can distribute that grade more effectively.
Yeah, and then the network seems to be relatively okay based on what you said earlier. So, with the gold price probably 2 or 3 times up or more from when they were mining it, labor's up in cost. You should make a lot of money out of a conglomerate region like that.
Yeah,
as long as you can get your approvals, etc. The one point that is worth talking about, I think, is what you're doing on the IR front and what your BE partner is going to do for you. Given you're an Australian miner going to tackle, a fairly interesting group of connected and disconnected mines in an enormous field, would you rather have a large company as a partner?
As a board, we're open to anything, but really what we've been in the process of doing is sort of probably addressing some of those issues. Really what we've done is really staffed it with local executives. To be very honest, we have sort of running 2 boards, an Australian board and a South African board, through which we're going to sort of rectify and make some pretty dramatic changes sort of next month to really give the team in Africa the power and the authority to deliver the project. We've got some pretty great BE partners in terms of knowledge and know-how. Some have had a lot of large jobs with Sylvania Stillwater, the delivery projects there. Our partner is very familiar with the local area. We have a lot of local ownership as well. So the landowners own 8% of this project. So in general terms, the locals themselves are very keen to see this project go forward. We do have an IR team in country as well that help us, Facebook and media, because I think what we forget sometimes as miners, because we're in a country is a little bit maybe depressed, that these guys don't have phones. Everyone's got a phone in the world now. So everything you put out to the market, to your social media channels, everyone sees. So we're very, conscious of that and how we go about things. But, we're pretty positive because we know the locals want this one. That's really, I think, the key in South Africa. You've got to have that social weight behind you, otherwise you're not going to make it.
Yeah, and I'm sure there's lots of ESG opportunities there with community involvement.
Yes.
Because it's, reasonably, I suppose, remote and lots of villages, etc. Good luck on that. Looks like a great project.
All right, thank you.
I guess we do see a lot of lip service paid to ESG matters by a lot of companies, but the simple fact of the matter is, if you want to get your project happening, you've got to have the implicit approval of your community, and actually that harks over to one of the questions in the chat box here from Scott Sobey. Thank you for that, Scott. And anyone else has got a question, please tap it into the chat box there. But Scott was wondering from the Black economic empowerment perspective, is there any threat to you keeping title there at all, or?
Like I said, TGME is the oldest incorporated gold company in South Africa. So basically, this ground has been held intact since the turn of the century, so about 130 years now. The BE component and the mining charter free, people always sort of go on about it now, but I was sort of listening to their presentation about today in ESG, and what South Africa is really building here is an ESG framework, maybe a little bit ahead of its time in a way, but some of those social issues are addressed through those charters and BE, diversity, inclusion, ownership, so we've got 26% local ownership down there at the moment, and the mining charter free is sort of looking at 30%. For us, it's 4%. We're not really that stressed about it, because basically we'll probably put some of that 4% into an environmental trust or something to actually improve our local region. We already do eradication programs of invasive species, so we'll return more water to the environment than we take away through the mining. We have sponsored teachers and community programs down there for over 5 years. We fixed the local school. We actually have feeding programs for some of the local school students. So about every morning, 60 kids get fed because of us. So this is not a short-term process for us. We've been doing this for 5 years now.
Thanks for that, Bill. And just for the last few minutes here, I want to, we've got another poll question here I want to get to, which is which commodity does everyone think? Well, I've got so many experts out there in the tuning in at the moment. Which commodity will be the best performer in 2022? While you're putting in those answers, I want to just go a little bit deeper into this ESG thing, and Dan, to go talk to Daniel Porter about it. I mean, how important are ESG matters when you're framing your desire or a plan to help finance a project? And if you give us any examples, if you can't, doesn't matter. But
no, absolutely. It's a good question. It's definitely something that we consider. We look at companies, I guess, from a fairly holistic perspective as well. I think when you're looking at the ESG sort of theme as it's running through, a lot of emphasis is on the E rather than the S and the G. So are companies getting better at what they do? Mining's a dirty game, right? We all know that. I think it's fair to say that you're digging massive holes in the ground, and there is going to be some environmental impacts from that, whatever you're doing. But I think if companies are improving and getting better at what they do, and they've got good governance structures, then that will feed into the rest of the company as well. And that's what we really look at, from that perspective. Are mining companies giving back to the community is also a very big consideration for us. But it's fair to say too that I think if you look at what's going on in the world at the moment with where energy prices have gone, there's probably a balance there that I think we all need to strike at the moment. But certainly, I think you can't look at a project now without that ESG overlay, and it certainly does feed into our investment case quite strongly.
Oh, thanks, Daniel. Clive, ESG for the more senior people like you and I, it's something that's a new thing on the block, but something we've probably always taken into account when you look at financing a company. How are you seeing these sort of threads coming through the financing side of things?
I think it's very, very difficult because the rules are not really set. I think I noticed that in the 2019 Mines and Money in London, Andrew, I think 30-40% of the conference was ESG orientated from memory. So, there's a lot of input going into this, and it's probably being driven out of Europe and the UK rather than us. And I think it's really institutionally driven. It started with, some of the core banks in Australia not financing thermal coal. It's now sort of moving to oil and gas and other areas, and there's all this hype on hydrogen, etc., and battery metals. I think it'll have to settle down. It'll have to become more pragmatic. I think in remote locations in difficult countries or non-OECD countries, it's much easier to do the S part, harder to do the G part, and everybody's got a problem with the, they know how to deal with the E part. But I think sustainability in, let's say, parts of Africa, if you take Bill's mine, setting up something that works for locals, whether it's clinics, schools, participation in the project, it all makes sense as long as the project can stand it. You've already got 26% that you probably have to give free carry on. So, only the better quality projects can really adopt a very high standard of ESG. And I think the problem will be trying to find solutions for the smaller miners, because if equity becomes tighter because they don't comply, it'll become compoundingly problematic.
Yeah, that's it. And Iggy, if I could just ask you then, when investors come to you, new ones, do they discuss this? Is ESG a big driver for them to come and knock on your door?
Yeah, absolutely. The battery materials plant that we proposed for Germany is in the process of being accredited. Obviously, if you increase your energy capacity of a battery, you virtually, we've estimated you can reduce the carbon footprint up to 50%, because essentially the batteries can be much smaller to give you the same energy output. So it's very important. As Clive said, there's a lot of money swirling in Europe and the US looking for climate change projects.
Yeah, that's very true. Wow. Well, let's have a look. How did that poll end up there? And wow, lithium's got the chocolates there. 38% of respondents said that lithium would be the best performing commodity in 22, followed by gold. Then there's something called other there. And Iggy, I can see you got your vote in there. It says alumina bauxite. So that's I was a bit worried about it for a minute after your excellent presentation today. Well, listen, there's nothing much more. Thank you so much. I want to thank everyone who dialed in today and participated. I want to especially thank our guests, Daniel Porter from Pure Asset Management and Clive Donner from the LinQ Group, and to our sponsors, Theta Gold Mines, Altech Minerals. Iggy, thank you very much, as well as the Resource Global Network. I'm Richard Morrow from the Melbourne Mining Club. We're delighted to work with Mines and Money on bringing these 5 at 5s together. We'll see you next time. Thank you very much and stay safe.
Thank you. And thank you very much to Richard for doing an excellent job at hosting this session. Thank you very much once again to Richard Morrow of the Melbourne Mining Club. Thank you.
Thank you. Bye-bye.
Bye-bye.